Hi everyone. So after we learned quite a lot about bonds, we need to relax a little bit and just review some of the fixed income markets. So this is today's topic. We will learn about global fixed income markets and in particular the markets in the US, Europe, Japan and China. So let's see what we have here. First of all, global fixed income markets. While fixed income markets are truly global, the vast majority of securities are originating in the US, Europe, which also includes the UK, and Japan. And I will speak a little bit about China separately because it is a very fast growing market, but it is still underrepresented in many indexes. So it is worth mentioning that the place of origination of those bonds are not necessarily the same as the location of the debt holders. So if the US is considered the largest market for bond origination, in other words, US government bonds, treasury bills, bonds and notes, are capturing a huge portion of the market, so those bonds are issued at the US, it doesn't mean necessarily that the debt holders are located in the US. Many of them are located traditionally in Japan and in the last decade or so also in China. So China's ownership of trillions of US Treasury securities clearly situates the central place of debt holders somewhere towards Asia. And traditionally it was Japan. So there are two different things here to differentiate between where the bonds are issued and who are the bond holders. So let's quickly review a couple of graphs and interesting information about different fixed income markets. This is a graph that expresses the China's bonds market size, and it is ranked the world's third largest, but it's still, like I said, underrepresented in different global indexes. So you can see that by issuances, and on the horizontal axis you have here the top 10 bond markets in the world in trillions of dollars, okay, based on second quarter of 2016. So the US is by far the largest bond issuer, Japan is the second, China is the third, but once again, a lot of the bonds that are issued in Japan are also held in Japan. There is a lot of asymmetric information. We're not 100% sure what is going on there, but in any event, Europe, which includes the United Kingdom, France, Germany, Italy, it's also a very large market. Canada below that, Netherlands and Australia is somewhere below. This is a graph that explains what happened over the years from 2000 to 2016 for the largest 7 industrial countries, the G7, the US, UK, Germany, Japan, Canada, Italy, and France. You can see what happened to the 10-year yields. Okay, just interesting to observe that you can see that those countries are kind of correlated, but in Italy you can see that the yield actually jumped starting from 2010, 2011, 12, but then kind of back to normal. This is in light of some financial crisis in Italy in those years. So when Italy found itself in a financial crisis, then obviously the yields of their treasury bonds jumped. Okay, Japan is pretty stable. You can see that the yield is relatively lower than those countries in Europe. Okay, this is because of long-lasting recession in Japan that preserves the yield and also the interest rate in this country at a very low levels for a long period of time, for a couple of decades actually. Another interesting chart is to observe the 10-year government bonds, the nominal yield for different countries. Also, this is slightly different time period from 2000 all the way to 2013. Okay, and you can see here the countries. The green light is Canada, the yellow-orange is Germany, blue is the United Kingdom, Britain, the black is Japan, and the purple is the United States. Once again, you can see that many of the countries here are kind of correlated, so there is definitely a correlation between the countries. But then again, Japan keeps its yield to maturity, the nominal yield to maturity, at a very, very low level, about 1-2%, sometimes even below that, very close to zero, for a long, long period of time. So Japan is a story by itself with this regards to the fixed income markets. Okay, let's learn a little bit more about the fixed income markets inside the US. So the US fixed income market is the most developed and highly segmented. It contains many different things like treasury bills, notes, and various bonds. Okay, just remember, bills are short-term to maturity, up to 1 year zero coupon bonds, while notes and bonds are longer-term maturities and they have coupons. The US fixed income also contains corporate bonds. A lot of corporations issue corporate bonds here, either high and low grades, different rankings, asset-backed securities that we will learn more towards the end of the course, mortgage-backed security, municipal bonds, foreign bonds, life insurance bonds, and so on and so forth. So there are many, it's a very developed market. There are many different securities that are issued within this market. Here is a breakdown of the US fixed income asset classes, and this is true for March 31st, 2016, which means at the end of the first quarter of 2016. So as you can see, treasury bonds captures roughly 32% of the market, mortgage-related securities 21%, and you can see the numbers also in dollar amount, which means $8.7 billion. $8.7 billion. It means actually trillions of dollars. Okay, thousands of billions or trillions. You can see the portion of municipal bonds. You can see federal agencies, money market, asset-backed securities, institutional level loans, high-yield bonds, high-grade bonds, and so on. But the vast majority are obviously the treasury bonds, the high-grade bonds, the junk bonds if you want, and the mortgage-related securities that we will learn in our last topic of this course. Let's observe what happened over the past 200 years, if you want to look at a bigger perspective inside the US. So this is starting from 1800, 1900, and 2000, okay? And let's see what happened to the yield of US government bonds over those 200 years with regards to a couple of interesting events that took place over the history. So the yield traditionally are standing at something like 8, 5, 6, those kinds of levels. There is definitely a rise here in the yields during the oil shocks here that took place during the 1980s. But then the yield brought back to this kind of level of almost 4%, which is the current yield. Okay, you can see here that the Anglo-American War increased the yield here. The Civil War increased the yield here, so wars in generally push the yield up. Okay, obviously, governments or institutions, they need to raise money. They have to issue more bonds at a higher yield. And they need to raise money kind of in an emergency, and definitely during times of war, then they have to increase the yield, compensate investors for the higher risk that is involved, okay? The crash of 1873 brought the yield down. World War I increased the yield. The crash of 1929 pushed it down. The federal fixed long-term yields was kind of here at the 3% level. The Vietnam War started, which was a long-lasting war, started to push the yield back up. Okay, two oil shocks created two peaks in the yield of treasury bonds during the 1970s, 1980s. And then the yield on US government bond reached its peak of a little bit more than 40%. And after that, the fall of the Soviet Union, which left basically just the US as the only superpower back then, pushed down the yield. So obviously, when you don't have competitors, you can issue bonds at lower yield and people will still buy it because that's a lower risk. And the rise of China as another competitive market then pushed the yield a little bit more up, but then the yield started to decline again and again, and we all know what happened to the recent financial crisis that took place during the years 2007, 2008, and 2009.